Good day Forex trader. Your USD Forex signal, bears in control as Euro clears key support. Bearish view. Sell the Euro USD pair and set a take profit at 1.1040. Add a stop loss at 1.1160. Timeline, 1 to 2 days. Bullish view. Set a buy stop at 1.1150 and a take profit at 1.1250. Add a stop loss at 1.1100. The Euro-USD pair retreated in the overnight session as investors started to predict that the current Russian crisis will push the ECB to slow its tightening. The pair dropped to a low of 1.110, which was lower than Monday's high of 1.1273. ECB in difficult place. Analysts believe that the ECB is at a difficult place as the crisis in Ukraine escalates. The immediate impact of the crisis on the European economy is on the rising energy prices. The price of crude oil jumped to $105 per barrel for the first time in more than 7 years. Similarly, European gas prices rose to the highest level ever recorded. The cost of other items is also expected to rise since Russia is being cut off from the world market. On Tuesday, Maersk and Mediterranean announced that they will halt shipping to and from Russia. This is a notable thing since these are the two biggest shipping companies in the world. As a result, while Russia will be the most hit, other European countries will also suffer. On Wednesday, Eurostat will publish the latest inflation data from the European Union. Analysts expect these numbers to show that the headline consumer inflation surged to 5.3% in February. Still, these numbers will not have a major impact on the pair since investors already expect that prices will rise in March because of the crisis. Therefore, the ECB has a balancing act to do. While higher interest rates are needed to slow inflation, more tightening will lead to significant shocks to the economy. The Euro-USD pair will also react mildly to the latest German unemployment rate data. The numbers are expected to show that the country's unemployment rate dropped to 5% in February. It will also react mildly to the latest estimate of U.S. jobs data by ADP. Euro-USD forecast. The Euro-USD pair crossed the important support level at 1.1123 on Tuesday. This was an important point since it was the lowest level in January. It also moved below 1.1100, which was an important psychological level and the lowest point last week. The pair has dropped below the 25-day and 50-day moving averages while the MACD and the Relative Strength Index, RSI, have pointed downwards. Therefore, by moving below these two support levels, it is a sign that bears have prevailed, meaning that the pair will likely keep falling. GBP USD Forex signal, more sell-off likely. Bearish view. Sell the GBP USD pair and set a take profit at 1.3240. Add a stop loss at 1.3300. Timeline, 1 day. Bullish view. Set a buy stop at 1.3360 and a take profit at 1.3450. Add a stop loss at 1.3300. The GBP USD pair declined sharply on Tuesday as risks in Europe continued. The pair dropped to 1.3300, which was the lowest level since last week. It has fallen by more than 1% below its highest level on Monday. Risk-off sentiment. The GBP USD pair declined as investors rushed to the safety of the US dollar. The drop coincided with the sharp drop of American equities as the Dow Jones and Nasdaq 100 index dropped by more than 600 and 200 points. It also happened as the price of crude oil jumped to the highest level in more than 7 years. Brent rose to a multi-year high of $105. Investors are concerned that the war in Ukraine is getting out of hand. On Tuesday, Russia continued to bombard key Ukrainian cities with bombs as a 40-mile motorcade of officials continued to approach Kiev. At the same time, there are worries that the sanctions on Russia will hurt the UK economy. Data published on Tuesday showed that the housing industry was still strong. The UK approved 74k mortgages in February while net lending to individuals rose to £5.92 billion. Further data revealed that the country's manufacturing PMI rose from 57.3 in January to 58.0 in February. The Nationwide Society will publish the latest home price index data today. The next key catalyst for the pair will be the latest ADP jobs estimate numbers from the UK. Analysts expect the data to show that the private sector created 350,000 jobs in February after it lost 30,000 in January. Historically, the ADP figure has no major impact on the US dollar because it is not a good signal of the official jobs numbers. The GBP/USD will also react mildly to the latest OPEC Plus meeting. Saudi Arabia has already hinted that it will stick to proposals by OPEC. GBP/USD forecast. The GBP/USD pair has been in a strong bearish trend in the past few days. On Tuesday, it managed to move below the key support level at 1.3357, which was the lowest level in January. It also moved below last Friday's low of 1.3326. It has moved below the 25-day and 50-day moving averages. The pair has also fallen below the 61.8% Fibonacci retracement level. Therefore, the pair will likely continue falling as bears target the next key level at 1.3250. AUD/USD Forex signal, double top points to more downside. There is a likelihood that the pair will continue retreating as bears target the next key support at 0.7170. Bearish view. Sell the AUD/USD pair and set a take profit at 0.7170. Add a stop loss at 0.7320. Timeline, 1 day. Bullish view. Set a buy stop at 0.7270 and set a take profit at 0.7330. Add a stop loss at 0.7200. The AUD/USD pair erased some of the gains it made on Tuesday after the latest interest rate decision by the Reserve Bank of Australia. The pair is trading at 0.7250, which is slightly below Tuesday's high of 0.7290. Geopolitics the driving factor. The AUD/USD pair rose on Tuesday after the Reserve Bank of Australia, RBA, delivered its interest rate decision. As was widely expected, the bank decided to leave interest rates unchanged at 0.1%, where they have been in the past few months. The bank also warned about the impact of the current crisis in Ukraine on the Australian economy. Precisely, it warned that the country's consumer prices will remain at elevated levels for a while because of the rising commodity prices. It expects that inflation will remain above 3.7% throughout the year and retreat in 2023. As a result of the crisis, the bank now expects to maintain interest rates at the current level for a while. Before the meeting, analysts were expecting it to point towards a rate hike in May this year. The rate decision came a month after it scrapped its quantitative easing program. Before the RBA decision, data by market and the Australian Industry Group pointed to a strong recovery of the manufacturing sector. The two PMIs remained above 50 as manufacturers cheered the growth of demand. The focus on the pair will be on the crisis in Ukraine that has pushed oil prices to the highest level in years. The prices of other commodities like wheat and aluminum also jumped. To some extent, Australia will benefit because of its vast natural resources. The pair will also react to the latest data by ADP on U.S. employment. Economists expect the data to show that the economy added 350,000 jobs in February. AUD/USD forecast. The AUD/USD pair declined to a low of 0.7240, which was lower than this week's high of 0.7290. On the 4-hour chart, the pair has formed a double top pattern. In price action analysis, a double top is usually a bearish sign. The pair has moved between the pivot point and the first resistance of the standard pivot points. It is also slightly above the 25-day and 50-day moving averages. Therefore, there is a likelihood that the pair will continue retreating as bears target the next key support at 0.7170.